Hello, hello. Welcome to another episode of the Real Wealth Podcast with Tommy Gleeson and Stefan Angelini. Tom Gleeson was referred to during the week as the face of the podcast, the pretty one. And supposedly I do all the talking. So if you're not watching, go and watch it. Hey? Now we're talking about different types of property today. There's a lot of different types of property out there. Tommy is going to go and ramble off the different kinds of properties we're going to talk about. Go for it.
Okay, so we're going to cover quite a bit of stuff, but also we're on a time limit because we can't just, as much as you'd like to, we can't just upload a 6-hour episode. Okay. So we want to cover this short and sharp with examples and give an understanding of the following things. Bear with me while I get through this. So we're looking at types of property investments under two broad categories: investing by yourself and investing with other people. When looking at investing by yourself, you've got, for buys and holds, you've got residential long-term, residential short-term, commercial long-term, and commercial multiple tenancies, which we'll go into. For development, develop to hold, which so build to rent, and then develop to sell. That's all by yourself. When investing with other people, we've got private investments, so you pool money together and buy larger assets. Unlisted trusts and companies, where you use an expert manager and you own a diversified pool of real estate. And then listed trusts and companies have an underlying portfolio that's owned, developed, and managed. And these are traded on the stock exchange. So that's what we're going to cover. Just keep it to, let's go short and sharp.
Yeah. So if you love property, this is a way to explain. There's so many different ways to invest into property. Don't have to just buy a house and get a loan for that house. There's heaps of options out there. So
we start with, sorry, go for it.
No. What we've got to do?
I was going to jump into it. You do the thing.
No, you do the thing?
No.
All right. So just letting you know that everything we talk about here is just general information. Please don't consider it as personal advice. And if you want personal advice, go and speak to your licensed financial planner. And guess what? We're licensed financial planners at Angel Advisory. So if you want any help with your finances, investing, or general financial planning, hello at angeladvisory.com.au is a way to get on top, in touch with us.
Don't get on top. Get in touch first. Yeah.
Thank you. Right, Tommy.
All right. So kick it off with investing by yourself. So we're looking at buys and hold. We're looking at residential versus commercial and different terms of long-term, short-term, and then we'll go into multiple tenancies.
Okay. What are we starting with?
Start with resi,
yeah,
because I think that's simpler to grasp and more people are going to relate to, and then we can move into commercial, leaping off the back of that.
All right, you give me which one, and I'm going to answer you.
All right, actually that's good because then I can keep you like to a time. So first one, residential long-term.
All right, resi long-term. This is just a general house you buy. So you go out there, you buy 123 Smith Street. You normally borrow money from a bank and you have a tenant in there that signs up like a 1-year lease and then just keeps renewing the lease. And if they're gone, the next person comes in. So because you've got a longer term lease, the risk is quite low and you can get really cheap debt from this because the banks love lending for this kind of property investment.
That's good. So the next one's residential short-term.
Short-term, right. Big thing that's popped up now. So rather than having just one tenant, why not rent out your property on short-term accommodation platforms, your Airbnbs, your stays? People try to do this now to use their holiday houses, but also get money from them as well. But other people just have apartments. Like a lot of people are buying apartments now to rent them out on short stay. So if they're close to the CBD, people don't need to go and stay at a hotel and pay $600 a night. They can stay somewhere and pay $600 for 4 nights by going through like an Airbnb or a stays.
Oh, so that is still that apartment in the city type example is still through Airbnb or stays or one of them. It's still that short term, like the weekend, long weekend.
Yeah. So you got people that are coming in there for a short period of time and they pay above market rate. You don't have the security of the long term. So I've rented out some things on the short stay, and there are periods of lulls. So you've got to be able to make those repayments when you don't have the secure income coming through. Yeah. So it's a riskier way to invest into residential real estate. But it is quite popular now.
So you're likely to be able to charge them out for more, but the length of the tenure is where the risk comes in because as opposed to having someone on a 12-month lease, you've got the Smiths 1 week, the Jones the next, or the weekend even.
Yeah. So if you have something that might rent out for $700 a week, right? That's $100 a night.
Yep.
That's for a year lease. Whereas you might want to target people that are going to pay $300 a night. Yeah. So if you rent it out for 3 nights in the week, then you make $900 for the week. Yeah. So as long as you're getting more than that 2 nights a week, then you're making money. So you got to get 3 or more, and then you're beating your residential strategy.
Yeah. That's cool. So that's residential. Let's go for commercial long-term, starting with long-term again, but commercial.
All right. Commercial property. First off, what are commercial properties? Basically things that people don't live in, factories, industrial,
retail,
hospitality, Just it's broad.
Yeah.
It's broad. If you want to see all the categories, go on realcommercial.com.au. So what do we say? Commercial, long term?
Long term, yeah.
All right.
With long term.
So long term, this can go really long, right? So you can buy a childcare center that's got a 25-year lease on it.
Really?
Yeah. So anything that's purpose built or purpose fitted out, they want a long-term lease because they put their money into it.
Yeah.
And they need to operate for a long time.
Yeah. Okay.
So you can have a 25-year lease on something, and the lease agreement will have it increase the price or the rent you're getting increasing by say 3% or increasing by inflation, many different options, right?
Yep.
So then you go less long-term, you might have, let's say you look at factories or so let's say factories, you might have a 5-year lease or a 10-year lease.
Yep.
Or you might have some retail or offices leased out for 10 years because they've got to do a fit out. So anytime they're putting money into the property, they typically want a longer lease time. So it gives you more security of your money.
Yeah.
Because no matter what, they're in that contract. They don't want to be there anymore. They've got to find someone else to fill that contract. I was talking to someone the other day. They've still got a property over on Spencer Street with all their signage on it. They don't run the company anymore. So they're paying rent because they signed up a 10-year lease.
Oh, what?
So they're still paying rent on the place. No one's there. So that's why owning a commercial property can be good. It's generally tougher to find someone to fill the place once they're out because there's less people. You got a home, you got a house.
Yeah. People
can always come in and a new rental will come in. The market's a lot bigger. In commercial, you've got to pretty much have a business that comes into there.
So once you get them, you lock them down.
That's it, lock them down. Then you got shorter term, so 5-year leases, which might be on factories, might be on smaller retail, things like that. Generally very rare that you get, say, 1-year leases in the commercial space. So it's normally longer than 1 year, which is what's typical in residential, but it can go from 5 to 25. But if you've got a hospital, you can have like a 30, 40, 50-year lease. So we're looking at a property fund at the moment. It's got an average lease expiry. We call it a WALE, or weighted average lease expiry, of 16 years. And it's like a healthcare fund. So it's mainly like aged care facilities. They own aged care facilities, they own hospitals, they own a whole bunch of different things in the healthcare space. Because the cost fitted out is so expensive, they want to take long-term, like 50-year leases.
Is aged care like hospitals like 30, 40?
Yeah.
Yeah, okay. Yeah. Because it's so customized.
Yeah, that's it. Yeah. So that's the long-term commercial game.
The next one is commercial, so multiple tenancies. The example of which we want to give an example. So an office building.
Yeah.
So you own the whole building. Within that office building, you've got floors upon floors of companies.
Yep.
And then below that, you've got retail.
Yep.
Then there's a coffee shop. There's who knows what else. But basically, you own the whole thing, and within that, there's a whole bunch of different people operating.
Yeah, that's it. So this is what we call it, like a diversified asset, normally reserved for people with a whole lot of money.
Yeah.
Because they're big assets, right? And if you're not looking for it, you probably don't see that 469 Lonsdale Street's for sale. Like you might not know that. Where it's so when we say diversified, because there's so many different tenants, if one moves out, it doesn't really ruin your cash flow.
Yeah.
So if you've got 10 levels and one level moves out, you've got to fill that one level, but you've still got 9 levels of income coming through.
Yeah.
And then you've got different lots of retail down the bottom. So you might have 4 different retail shops. If one person moves out, you still got 3 that are paying rent. So you got security, and that's why big families like to own these things, or big companies. And this is what you see a lot of the fund managers invest in, because they've got a lot of money, but they want to make sure they're paying their investors a consistent return. And that's why a diversified asset, someone's got a lot of people in there, it's a lot cleaner because there's a lot more smooth cash flow.
Yeah.
But let me just bring it back to like what's also becoming very popular. It's a commercial investment. It's diversified different income streams, but it's cheaper. So you might have like a group of factories or factory outs within a big factory lot, or you might have storage facilities.
Yep.
Where storage facilities everyone rents out a storage cage. But also you might have rooming houses. So you might have a house and everyone rents out a room within the house. One person moves out, you still got eight people paying rent. So that's like, these are the more affordable ways rather than buying a big office building that you can get in, but at least you own, this is all about owning the asset yourself.
Yeah.
Not owning it with other people.
But it comes with that security and consistency.
That's it. Yep. Stable cash flows. So that like you own a long-term commercial property and you have one tenant, that tenant moves out, you have no income until you get that next one.
Yeah.
Which is a killer.
Yeah.
Have cash ready.
Yeah.
So yeah.
So that covers investing by yourself.
Mhm.
Now we want to look at investing with other people. The first of which is private investment. So where you're pooling money together to buy bigger assets.
Yeah. So like you got a lot of people that just come together, family members and things like that. And they might form what's called a unit trust, a company, or you can even get self-managed super funds together if you want to get really tricky and be good from a tax planning perspective. Punch. Call us if you want any more information on that. But yeah, this is like groups of people pulling their money together. This is what causes issues though, is because you got different people all participating in the one thing. It can cause issues because everyone's got different scenarios. So if someone needs to sell out of the property, then you need to have everyone agree to sell the property to give that person their cash back, or someone has to buy them out. And depending on the structure, we've got stamp duty here in Australia. Yeah. And we've got capital gains. So the person selling might have capital gains. The people buying might have to pay stamp duty again to buy the asset at the market rate. So there's complexity around owning it with other people. You've really got to get along with those people. You've got to know their entire situation. And we actually say it's probably better to own it on your own, because you just don't know what's going to happen with other people.
Someone else suddenly needs access. But then if it's a unit trust, isn't it unitized? So one person can exit.
Yeah, but
not cleanly, but cleaner.
How do they get their money?
Oh, sorry, I'm with you. Yeah.
So like everyone puts in, let's say they want to buy, 4 people want to buy a $2 million factory.
Yeah.
Right. And they don't want to use any debt.
Yeah.
So everyone puts in $500,000.
Yeah.
They got the $2 million factory. One person goes, look, you know what? I'm getting divorced.
Yeah.
I need to pay out my wife.
Yeah.
So I need my $500,000 back.
Yeah.
And then everyone else has to go, all right, well, our choices are, do we sell the property? And everyone sells out. Probably won't want to happen. We're going to buy you out. And if we do buy you out, who's going to pay the stamp duty? Because we've got to pay it on that $500,000.
Yeah.
Sometimes, depending on the structure, depending on the state. And that's where it just becomes tricky, because you've got to deal with other people. You don't know.
And whichever scenario, whichever path you go down, your hand was forced. It wasn't a decision that you made.
Yeah, that's right.
You're running to keep up.
But if that person owned the property in their own name, they don't have to go back to 3 other people and say, I need my money.
Yeah.
They just go, I'm going to sell the property. So, and that's why just watch out if you are getting into other people. These are some things that can pop up that we see pretty regularly.
Fair enough. All right, next one, unlisted trusts and companies.
All right, unlisted trusts and companies. So this is normally by professional managers who have a pool of assets. They've normally got money coming in, so they go off and buy assets. Their job is like property managers, development managers. They own assets. They buy assets, they own assets, they develop assets.
Yep.
And you get a portion of their growth, their gain, their sales, their income.
Right.
You normally pay these people a fee to manage that portfolio.
Yeah.
But the benefit is you get a diversified group of assets when you buy it. So we've got one fund, for example. Let's say people want an industrial property fund. You know how hard it is to find a factory out there that you can own by yourself? You probably don't know, but it's really hard.
No, I don't, but I can imagine. So you want exposure to that, but you're not going to go out and buy a factory.
Yeah. But you might say, look, I want exposure to the asset class because I like that kind of asset.
Yeah.
I don't like a lot of debt. So what I'm going to do is I'm going to invest with an unlisted property company.
Yeah.
I'm going to give them my money. They've already got a pool of $1 billion worth of assets, and they are actively in the market trying to buy more.
Yep.
And generally they buy a higher class of asset for that space. When I say higher class,
what do you mean by that?
They assess the tenant, they assess the property, they see if there's any issues. They do all the work going into it because they don't want to lose your money.
Yeah.
And then all of a sudden you're into this property fund and you're a part of 100 properties, all with different tenants, all with different lease expiries, all paying rent. So you get the consistency of the rent.
Yeah.
You get the portfolio that might have capital growth or even capital losses, but it's diversified because you've got 100 properties.
Yep.
And you've got someone actively looking at the leases, at the people, at the management, everything like that.
Yeah.
And then as more money comes in, guess what they do? They either pay down debt or they go and buy more assets.
Of course.
Yeah. So that's where your portfolio can continue to grow with more assets and get more diversified as more people come in.
Right.
So that's a way that a lot of our clients like to do it because they don't like having a lot of debt, especially when debt's very expensive.
Yep.
These companies that we're seeing, like you do have companies that have a really high debt level, like 50, 60% loan to value ratio. But the ones that we see normally have like a 20 or 30% debt ratio, and they get debt a lot cheaper because they're not borrowing $1 million. They're borrowing $100 million or $1 billion.
Yeah.
So they get rates really cheap.
Yeah.
So that's like more, you're on that wholesale class, and you want it to be a long-term investment because some that we use have monthly liquidity. So they'll pay people out on a monthly basis.
Yep.
There's one property fund in the US that's recently popped up. They've got $71 billion of assets. They had $5 billion of people ask for their money back in January
of this year.
Yeah.
What was the catalyst for that?
People want to get out of the space. Yeah. So, like, you normally can't get your money back. They're going to say, well, we can't pay you back because it's all locked up in real estate. What are we going to do? Sell the property?
Yeah.
So you just want to make sure it's a longer term perspective.
Yeah.
Some of these companies are what they call closed-ended funds. So you can't sell out for, say, 7 years.
Oh, yeah.
So they're going to lock your money in.
Yeah.
Or there might be an open-ended one where you can sell your shares as you go.
But the situation may arise where you say, I'm out, and they turn around and go, not yet. You're not.
Yeah. So yes, so what we do is we've got managers that have monthly liquidity, quarterly liquidity, yearly liquidity, or every 4 years, or every 7 years.
Yeah. Okay.
So there's different options.
Yeah.
But
all right, so that is unlisted trusting companies. We want to cover off on listed trusting companies, how they differ.
All right. This is what anyone can buy. So normally with the unlisted part, these are just like unlisted companies, but except they're on the stock exchange.
Yeah.
Unlisted is you get the value of the assets within the portfolio as they get valued, right? So that's what you buy a portion of that, you get the actual valuation.
Yeah.
From a listed perspective, these guys are listed on the stock exchange. So anyone can buy them. You can buy them for really cheap. So if you got a stock worth $34, you can buy one of those stocks.
Yeah.
Right. But then there's a market valuation of the stock versus the market valuation of the assets in the company. So
this is where it gets juicy.
It is. So you might buy a company. Let's say they own shopping centers.
Yep.
They get a value, come through and value all their 100 shopping centers that they've got. And they say your shopping centers together are worth $10 billion.
Yeah. So
it'd be good to own part of that $10 billion, right?
Yeah.
You got a company like Unlisted, they're managing it. It's diversified, different income streams. You've probably got a consistent revenue coming through.
Yep.
They do everything.
Yep.
Right. But this is what happens in the listed space. Because they are traded to the open market, it's a demand and supply game. So what we're seeing, and at the moment, is a lot of these property companies, listed property companies, are selling at a discount to their net asset value. So what the assets are actually worth. So if the assets in the portfolio are worth $10 billion and they're selling at a 20% discount, then the actual market valuation of the company on the ASX is $8 billion.
Yeah.
Which is like, all right, well, am I getting a 20% discount for these assets then?
Yeah.
You pretty much are.
Yeah.
But you just got to wait for everything to come back to equilibrium, which it normally does. But that's where you got the more volatility. Whereas people don't invest in property for volatility. They don't want ups and downs. They want secure. I don't want to see the value of my property until I have to sell it. That's where everyone loves real estate. It's just like it's steady. I can drive past and what I'm investing into, it's good. But that's where like the listed property stuff differs. Same kind of assets, but publicly traded. But I'll give you an example of like returns. I've done a lot of research on returns in stocks between the year 2009 and 2019.
Oh, yeah.
So there's the Australian Stock Exchange top 200 companies.
Yep.
In the year 2019, they returned about 23%. And over the 10 years up until 2019, it returned 7.38% on average per year. Whereas the listed property companies in the top 300 ASX performed better in that 1 year. But in the 10 years up to 2019, they returned on average 11.2% per year on average. So over that period, they were a higher performing asset class because Australians love property and the valuations have gone up, meaning it's really good. So that can be good. However, that volatility is huge in that space. So if you look at like a chart, like an asset return chart, you might see that you might have, they call it AREITs, Australian Real Estate Investment Trust.
Yep.
On the bottom of the asset return chart on a few years, especially during like GFCs and downturns like we've seen. But then the best performing asset class in years following. So very volatile. But I reckon that's it.
That might be it for, actually, that wasn't too bad. I thought you were going to really press up on out, but I kept to my top points.
Yes.
And I had one eye on the clock.
So property, what people don't realize is there's so many ways to get involved.
Yeah.
Especially when you don't need to use debt, don't want to use debt, want to have it as part of your retirement strategy and just want long-term hold.
Yeah.
The different properties are right for different people. And that's why, that's why we exist.
Yeah.
We help people identify what is out there, what are your options?
Yep.
And then go, right, well, these are your options. What's
how are we
best?
gonna do it?
What's best for you? Yeah. And then how do we implement it If you've got 10 grand, well, you can't go and buy a property.
Yeah.
You can't go and buy a residential property.
But you don't want to miss out on what you're seeing from the property market. There's different ways to get in.
Yep, that's right. So plenty of options out there. We love real estate. I love real estate.
You do.
Your force love real estate.
I mean,
because we love real
it's
estate.
Infectious. Yeah.
Australians love real estate. So I'm going to say thank you for listening. Hopefully you've learned a little bit in this podcast. Anything else you want to add?
Hit us up. Any questions? Let us know.
Thank you very much. We will see you on the next edition of the Real Wealth Podcast with Stefan and Tom.
Good finish. Strong finish.
Have a great week. See you soon.
Cheers.
Bye.